My name is Andreas Kyrilis. I'm a partner with Bain and Company in Athens, and we're going to be talking, of course, about private equity. And 2023 was indeed a difficult year. And I'm sure the question in everyone's mind is, when are deals going to be back? Today we're going to discuss this topic, along with a few other interesting questions, such as the macroeconomic developments impact, the exit, the challenges to exit, amount of dry powder and financing options, with a panel of esteemed guests, and introducing them, starting with Georgios Elekidis, Principal with Bain Capital, Iossif Kiouroukoglou, Managing Director and Country Executive for Greece with Bank of America, Chryssanthopoulos, Senior Partner with EOS Capital Partners, and last but not least, of course, Spyros Venetsianos, Head of Structured Finance for Eurobank. Welcome you all, and before entering the discussion, I'd like to paint briefly the background by sharing some facts from a recent Bain Global Private Equity report. So in 2023, the industry was indeed affected heavily by the rising interest rates. The outcome was that the deal activity continued falling by record numbers that we hadn't seen for a very long time, since the global financial crisis, and exits are emerging as a key problem for GPs. We're talking about 3.2 trillion of unsold assets, about 28,000 companies on the books, adding pressure to the system. Fundraising was relatively strong in the past year, contributing to a quite significant amount of dry powder. So deals will be back, yes, but a reaction will be needed by the industry. If we go into a bit more detail into a couple of these points, borrowing costs did jump by around 500 basis points in 22-23. And as you see, the global buyout value was limited to approximately 440 billion. We're talking about a 60% decline from the 2021 peak, which we hadn't seen since back in 2009 or so at that scale. The deals of all kinds of deals were impacted, but especially deals dependent on bank financing suffered most, as of course yields on the large syndicated loans reached 10-year highs, more or less. And just to mention that the private equity mega deals of over 5 billion or so were cut in half for the past year. If we now move to the other side, look a little bit on the fundraising. So private capital fundraising has continued. It did raise an impressive amount, creating a total dry powder of 3.9 trillion, quite an impressive amount. Still, fundraising 2023 was actually down, if we look at it by 30% from records of 2021. Buyout funds within that showed a relative strength in the broader fundraising market. But at the same time, what was interesting is that 50% of the capital raised was done by the top 20 funds. So indicating, flight towards safety, so to speak. So where we stand right now is that buyout funds are sitting on a total record dry powder of 1.2 trillion. And what is also interesting is that 26% of this amount concerns vintages of 4 years and older. So this is creating, expectedly, pressure on GPs to start activity, buying activity, even if conditions are not necessarily ideal. So looking ahead, we see that global private equity is seeing to pick up in activity gradually. And let's not forget that it is a market that for the past 10 years has been growing quite a lot, and LPs continue to have appetite for the asset class. So conditions appear to be shifting in favor of the market, but is 2024 going to mark a shift? And starting with you, Georgios, do you believe the stabilizing microenvironment has reached a stage where it can have a real impact on underwriting?
Thank you, Andrea, and good afternoon to all. So indeed, there's been a combination of dislocating factors, which we all know, over the last 4 years: COVID, wars, stagflation, increased costs. So all of this led to uncertainty across all global markets, as we know. And different markets have been hit differently. Indicatively in Europe, you see like the North and traditional core markets being impacted the most because of the reliance on costs, on industry costs, and also the traditional appetite for leverage. So when interest rates went up and leverage, they were highly leveraged, so the impact was bigger. Southern Europe, Greece, has less of an impact simply because we started from a lower base. We have committed funds from RRF and all the things that have been said in previous panels. Still, the macro indicators have started to, let's say, point to a soft landing, so a stabilization. If you see the manufacturing and the services PMI that have been improving, bar Germany, which is the big, let's say, question mark here. You see the housing market that has not collapsed, as they were all betting. UK actually, if you see the application for new mortgages has gone up, and US is already in an uptick. So all in all, there is signs of stabilization. In terms of investment, and looking from the perspective of a special situation investor, I think it's a good time to use all our palette of products to different geographies. And I mean different geographies that it's, let's say, a scarce opportunity for distressed investors to tap on core markets and core assets, like accessing Germany, France, UK, real estate markets. It's one opportunity in a cycle. And also invest in Greece and Southern Europe, which still it's growing economies, but there is a backlog of dislocated opportunities of the past. So the product is in the geographies. The product that we have as PEs is not only the traditional equity investments, but also the private credit, alternative lending, other tools that we can access this opportunity and tailor-made solutions. So I would say the appetite is there. The funding is there, as you mentioned. We're sitting in funds that need to be invested. So, the opportunity, we have to tackle it. I would just say that it's a final conclusion that there is a more rigorous approach in underwriting, simply because geographies that were traditionally good and sectors that were considered prime, investing in offices in Germany, they've gone south. So you need to think twice to find the right opportunity.
So macro environment is allowing for careful, so to speak, step forwards, as you mentioned. Still, we are talking about 3.9 trillion of dry powder. How do you see this pressure actually manifesting in the market, Iossif?
Thanks, Andreas, and thanks for the invitation from my side, and good evening, everyone. Look, I think it's clear that the last couple of years, for all the reasons Andreas mentioned, it has not been a conducive market for private equity investors to realize exits. Mostly lack of visibility of the macro. Is the hard landing, is the soft landing? Secondly, very importantly, I think, lack of visibility on what's the peak interest rates and what's the path for that to come down, right? So very hard to price assets. And so people have been postponing exits, right? That has, indicatively, just to give you a number, last year, M&A, private equity-driven M&A activity was down 37%, just 1 trillion. And so that backlog exists. Now, at the beginning of the year, having discussions also with some LPs, it was clear that the pressure for the GPs to realize exits was mounting to the extreme that certain LPs even were considering to stop delivering commitments until some realizations and exits were happening. But I think the reality is that LPs are sensible, and the pressure is there, but not at any cost. Having said that, and I think because of all this improvement in the macro environment, I think we are in a point that we anticipate a much busier 2024 in terms of M&A activity on this front. But challenges remain, and I think the key challenge still is a little bit the kind of bid and ask spread on the valuations. There are a couple of factors on this. The first one is critically looking at the business plans the sell sides are putting forward. So a lot of buyers will take very, very conservative approach on the numbers. They reflect upon the last couple of years. Some business plans or some companies have benefited from the recent very loose monetary policy environment, so they anticipate that numbers will start to get challenged a little bit going forward. So they tend to be very conservative on this. And so this gap is still there, right? But high-quality assets will trade. I think we're seeing that, and we're seeing increasing amount of work done by both strategic but also private equity funds in anticipation of this pipeline that's coming.
Taking the cue, and apologies, Nicola, I would like to go to Spyros for a second. And the syndicated LBO issuance was quite low in 2023. So we are in the look for alternative or innovative solutions. So how do you see financing solutions, capital structures evolving in this new rate environment that we're experiencing?
Okay, thank you very much for the question. Actually, we are the secondary raw material for all these transactions. This raw material became more expensive, even if margins are dropping. We cannot compete with the Euribor. Nevertheless, in parallel, we have a regulator who is initially suggested that we have to be careful for leveraged transactions being those that are higher than 4 times EBITDA. And later on, he came back and said, you know, if you are supporting a financial sponsor, regardless of leverage being 2 times EBITDA, still is a leveraged transaction. So it's creating an environment which is not very friendly for banks. However, we like this kind of products and we like such kind of transactions. And the biggest challenge is that you always have to adopt to the phenomenal creativity of private equities. So, you know, structures are mainly to adapt to the needs, but I can reveal to you 2 trends that we see. The first trend is that private equities require us not only to finance the acquisition, but come with a full package that is requiring CapEx financing, working capital financing, factoring, plus a hunting license. Financing for further acquisitions, either committed or uncommitted. They are called accordion structures, so as to have more dry powder and not to knock the door to the shareholders for additional equity capital. The second trend that we see is that through the exit strategies, we are called to relever the company before the exit. So actually, the seller is trying to optimize the capital structure and take away questions on whether the Greek banking market is able to finance it, what are the rates, what are the terms. They're saying, oh, don't worry, I'm going to make it as beautiful as possible, as efficient as possible, and you take it in a package. So these are the 2 new trends that we see.
Mm-hmm. So prudence in innovation as emerging as a demand, of course. And Nicola, on a side topic, or a topic on the side of the discussion, I'd like to shift and looking at the value creation in the past 10 years had been 50-50 between revenue growth and multiple expansion. In the same logic and spirit of prudency, we see more and more emphasis on the margin expansion, which played, I would say, limited role before in value creation. What opportunities do you see going forward and in this increasing emphasis of margin expansion?
First of all, it's undoubtedly, from a global perspective, and whatever we heard by the gentleman here tends to have this type of bias, is that the margin expansion is playing a more increasingly important role in creating value. Now, that's reasonable, because when you have to manage the transition from 0 interest rates into today's environment, even if we see de-escalation in the future, still you don't have that free lunch, and you need to think twice about the trade-off between cash burn and the growth you want to target. That's one thing. On the other hand, inflation in most sectors is a challenge. You need to make sure that you can manage inflation in a way that you can preserve at least your margins. So the reaction has been absolutely rational. I think what we see in Greece, though, is a bit different. First of all, we have we invest in companies that are unlevered, predominantly extrovert. They are relatively small still, have a lot of potential to grow, and that allows them, I think, to be a bit more focused on growth. So I would say in Greece we would still favor growth over margin expansion, but definitely margin preservation is important so as not to compromise the value of the business when you want to exit. And that's where I think new funds provided also by the private equity industry are useful, because you can actually front load the investments needed to allow for the economies of scale benefits and the reduction of the marginal cost when you want to exit. And in our case, we've seen it in all of our investee companies in the first fund. We saw at least 50% increase in sales and EBITDA over the 3-4 year period we have experienced to date, a doubling of FTEs, but margins have been more or less resilient, and that's important, I think. So Greece is probably a bit more balanced right now, and I think will continue to be. Of course, as we see rate de-escalation, maybe the trends will also reverse internationally.
So margin preservation while growing then. Georgios, coming back to you, and despite the efforts of Spyros and the banking system more broadly, there's still a gap left by banks, and private credits is feeling part of this gap, or a meaningful part in the mid-market at least. Do you see a continuation of this opportunity for private credit?
Look, I would put it differently across geographies again, because unlike the US, which is a more compact economy, here it's more fragmented economy, so it's different solutions by geography. Spyros explained very well why the need is there, because of regulatory issues, because of less supply of credit, given that banks, especially in the north, start having their own issues, so they focus on the back book rather than giving new loans, expanding new loans. And also because the demand is higher from sponsors that would not take a loss now, but they would take a more expensive financing to delay the exit until the market normalizes. So this is why the need is there. So it's all into macro. I think as long as we say that Northern Europe has not seen yet the full reflection of the last couple of years of interest rates, then we would say the private credit is still there. Greece is a very different market because, as Spyros again mentioned, the local banks are keen to lend. They've cleaned their balance sheet from NPLs, and also they have lots of capital to lend. I think the private credit, which to my mind is more a palette again of asset-backed lending, specialized capital solutions, etc., could have views in Greece, fit in Greece, more like providing solutions to the 60, 70 billion of NPLs, which are not in banks, but they haven't disappeared, they're in servicers. And a lot of these are viable, looking for financing for DPOs, financing to buy back assets at auctions, new buyers that want to buy assets at auctions. We're talking about hundreds of thousands of real estate, which actually becomes economic inefficient simply because there is no credit, or there is very limited credit for this aspect. So yes, I would say private credit is there, but in different shapes and forms, depending on the economy.
Iossif, you talked before about exits, and we saw how exit or challenges in exiting is a real issue. Shifting a little bit towards broadly liquidity, how do you see that GPs can create liquidity beyond traditional exit routes?
That's a great question. Thanks, Andreas. And I think Spyros alluded to one of those. There's a number of tools that the GPs have available. The one is the refinancing and dividend recaps. Sometimes the banks don't love them, but it's also a profitable business. So it's one avenue where this is capital optimization. In fact, we've seen a lot of that happen even ahead of M&A process, because then you can try to introduce some portability features on the debt package and make the de-risk a little bit more the transaction in certain cases. So that's there. Other avenues is to look at maybe monetization of a minority stake. That makes the value debate slightly easier. It complicates the governance debate, and it complicates also the full exit debate. So it's their pros and cons. But we've seen, reflecting in the last couple of years, a number of minority trades took place. Today it becomes a bit harder, but it's there. And lastly, there is also the tools that GPs can borrow at fund level for the implied equity in the portfolio. It's a bit more aggressive form. It's effectively like pre-sale, but that's also there, available. And now, certain assets, if an asset is good and you just find yourself in an environment that is not great to monetize it, what we've seen a lot is also continuation funds take place. And when, because the pressure point effectively comes when you come to the end of your fund and you still hold a good quality asset, right? And LPs have been in the past receptive in taking ownership, direct ownership of such assets. It has its complexity as well as a process, but it's something which is well established. So yeah, GPs have these kind of tools. But maybe the final thing I'll say is that when we reflect back in the recent months, even earlier this month, we do see large transactions still happening. So I think for good assets, the market is there and the valuation debate becomes less acute. You may have seen kind of the tech private of Endeavor Group by Silver Lake, 13 billion transaction at the beginning of the month. So there is appetite for large equity tickets to be underwritten. There is credit. The market is kind of improving, and I think GPs have a number of options.
So avenues for exit and liquidity are there on the right for the right assets, as you mentioned. And Nicola, how do you see the situation in Greece in particular? What do you see as potential ways of overcoming exit challenges in the Greek market?
In this case, maybe Greece is a bit similar to the international paradigm. So, number one, selling companies, I think, is part of the game. So this is what you do. You need to manage this, and it may take a bit longer, or it may come earlier. So it's not something that private equities are not ready for. So I think that's core business, number one. Number two, there may be, the IPO route is probably not a core route yet for Greece, especially for the types of companies we invest in currently. But it's very encouraging what we see in the ATHEX, definitely increased volumes and increased interest. So that could be a potential option, but still it would be probably a complementary strategy. Now, as regards, I think, any sophisticated investor, trying to conceptualize the exit before they invest is a very good idea. So probably co-investing with strategic is a very good way to ensure you have a natural buyer when you mature the company. Also making sure you understand what the big boys in terms of financial sponsors want, and what type of size bracket they want to hit when you actually manage to bring it into their scope. And finally, all the tools Iossif mentioned around liquidity events that can be useful in the meantime. That buys you time, gives you a valuation benchmark. It doesn't really solve the problem. So these are just things to keep, let's say, value instead of monetizing at the wrong time and obviously leaving value on the table. So I think there are quite a few things that we are doing. And don't forget, Greece and valuations in Greece are not that demanding. So the bid ask shouldn't be big.
I think we will all agree, or all our panelists will agree, that the banking system, the Greek banking system, can play a role to help the private equity market in Greece mature. So, Spyro, what do you think are the most important aspects of this role that banks can play?
First of all, I'm feeling a bit worried because I'm the most bullish person in this group, and as a conservative banker, this is a signal that I'm doing something wrong. But let me give you the reason why the Greek banking market has appetite for such a product. And the reason is that, of course, we are driven by the significant liquidity and capital that we have. So we are not allowed to reject any good idea. And why this is a good idea, I'll tell you. First of all, progressively, we have built some experience and some relationships with private equities that make us more comfortable on how they operate and how they react in challenging times. So this is part number one. Part number two, over the years, we have trained ourselves, the back office of the bank, the credit committees, in order to understand this type of transactions. I remember probably 7 years ago saying releveraging in a credit committee was a no word. You shouldn't have said that. Now it's allowed. So that requires training, and you're going to tell us. But anyway, and the last part is I think we have gained some experience from the crisis. So theoretically, we know what works, what doesn't work, what has survived, what hasn't survived. And at the end of the day, something a colleague of Iossif told me once is that you have less sentimental banking. You have technocratic banking, which is something to consider when you are considering a credit. So in this framework, I think, but the clients will tell, that we have created a framework on the basis of which the terms are competitive, especially if they are compared with Western Europe. I think that we can provide some competitive terms. I think that we can deliver on time. In the past, there was some uncertainty. Yes, you are bold, you want to give money, but can you actually understand? Can you actually structure the transaction? But there is a whole ecosystem by lawyers, by tax experts that work together with the banks, and I think we can deliver. And the third aspect is that we can underwrite significant amounts compared, of course, to the size of the Greek banking system. So in a nutshell, I think that we have happy clients, but you may ask them yourselves.
We can always be happier, Spyros.
Of course, of course.
So I wouldn't say pessimism, but I hear is cautious optimism and balanced cautious optimism from the different perspectives of the market. If I ask you to go, to close with one remark, one sentence on how you see 2024 ahead, starting with you, Georgios.
Look, last year we were saying uncertain. Now this year, you know the uncertainty. So we've lived through it a few times. We're still investing. Actually, we've expanded the products that we invest. So it's up to the market to bring good opportunities for us.
Yes.
No, look, I think I would say cautiously optimistic is the right word. I think there's much greater visibility on the macro, much greater visibility on the interest rate path potentially coming down and kind of helping also valuations. And I'd say that hearing Spyros, it kind of reminded me that also leverage can be a solution to bridging the value gap, right? Because if you right size the debt, you can kind of hit the returns you need, right? So this is part of the solution sometimes. So as I was saying, we're already seeing big transactions happen, and I think 2024 will be much, much busier than 23 in deal flow.
Nicola.
I'm very optimistic. I see that the value that one can create with Greek mid-sized companies is still there. And having a private equity, and especially a Greek private equity there to help strategically unlock this value is definitely a plus. So there's much more to do.
I think I said it all in the beginning, but
Great.
I'm very optimistic that we have a number of private equities coming in the market, getting bigger, getting more experience, getting their GPs and LPs happier. So I think that, if our clients prosper, then there is a good opportunity for a bank to prosper as well.
And we close with that message, quite on the optimistic side. Thank you all very much.